Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Today, my guest is Rohit Savant. He is Senior Commodity Analyst at CPM Group, specializing in the precious metals. Rohit, thanks very much for coming on the program. Appreciate it.
Thanks for having me here.
So, precious metals, you're the specialist. Give me your outlook. Let's start with gold right now. Gold ran up recently to over 1,900 an ounce. We've seen a pullback. Is this the end of the run? Is there more to go?
I think in the short term, we still have more to go.
How much more?
We think gold prices can go up to about 2,000 or 2,100 over the next 3 to 4 months. We should expect continued volatility in prices for an extended period of time. With the election year coming up in 2012, we do think that's also supportive of prices. So we do think
the election year.
Yeah.
Why?
Just because I think a lot of the support for gold is coming from investment demand, and if investors continue to remain skeptical and concerned about whether policymakers are actually going to be able to do something right, that's probably going to be the reason why the election year would play an important role in.
But so. Educate me on this a little bit. I mean, the policy that we see, for example, in Europe and what we're about to see in the United States, it's deflationary. You're talking about austerity. We see the contraction in GDP everywhere, okay? All this is deflationary. Is that a good environment for gold? I mean, aren't people investing in gold because they're afraid of inflation or hyperinflation? Aren't we seeing the opposite? And at the same time, I'll just throw this in, you're also seeing an historic rally in U.S. Treasuries, in public sector debt instruments.
Right.
How do you square the two?
I think it's a little bit of a concern in terms of the longer term view that people have on the U.S. dollar. And I think that is one of the reasons why you're seeing this move into gold. And even though things are deflationary, and at the moment you're seeing this sharp increase in demand for treasuries, there is that underlying concern about the US dollar going forward, and major currencies pretty much across the world, and what the outlook for those would be. And I think that's one of the things that is helping to support investment demand for safe haven assets.
Okay, so on the demand side, the main driver now looks to be investment demand. Let's talk about the supply side. How does it look? How does total mine output look? Global supply of gold, is that on the increase? Is it flat? How does that look?
Mine supply is actually on the increase. We expect mine supply both for gold as well as silver to increase in coming years, largely because of the sharp run up in prices, the relatively low cash costs for producing these metals. That definitely provides an incentive to miners to go ahead and bring this out of the ground. So in terms of mine supply, we do expect this source of supply to increase at least over the next 3-4 years fairly rapidly.
Now that level, is that at a historically high level, or is it still below a peak that we saw previously?
Eventually we do think it gets back at least to the peaks that we saw in the early 1990s. So yeah, in the case of gold, we do expect that to happen.
So we haven't hit that point yet?
Not just yet, but we should be hitting that point very soon, in the next year or two.
And what's happening also, the main component of demand, or historically, has been the jewelry industry, right? Demand there is what? It's flat to down?
It's flat. It's down mostly in the developed markets, because jewelry wouldn't be your priority for spending when you're going through a tough economic environment. But you are seeing fairly healthy levels of demand for gold, especially in developing markets, where a lot of investors there, especially the lower income group investors in countries such as India and China, where they basically use gold as a form of saving. So they would basically change that into some form of jewelry or something, and that's how they save. So demand there is still fairly healthy.
But what about, we've been hearing a lot about central bank buying of gold. China, for example, how much is that a factor?
Central bank buying of gold is an important factor. It's definitely helping support the whole strong investment demand side of the gold market, and we do think that has played an important role in pushing gold prices higher in recent years.
So right now, still some upside in gold as far as you can see.
Yes.
All right, let's switch to silver. What are the fundamentals? How do they look to you in terms of supply and demand?
As far as silver is concerned, we think that silver is basically going to be doing a sideways sort of volatile move between probably the mid 30s to around 42, 44.
So you don't see it getting back to that $50 level?
We don't think, not on a sustained basis. Maybe you see a spike up there, maybe for a day or two, but nothing more than that. So, and that would also be something that if something jolts the market, you probably see prices go up there, but most likely not.
Now, silver has more of an industrial component to it, right? I mean, it's an industrial metal.
Right.
It has industrial uses. So it is more economically sensitive, would you say?
It is. It is economically sensitive, and that is one of the reasons why we think that if the global economy does move lower, growth in the global economy moves lower, that would adversely affect fabrication demand for silver.
Now, what is the cost of production for silver?
The cost of production at primary mines on an annual average basis is about $5.
$5?
Yeah. So
that's down there.
Yeah.
I mean, we're at around $40 right now.
Yep.
Isn't it historically the case that commodities eventually trade back down to their cost of production?
That is true. We do think that silver prices over the longer term would revert back to lower levels.
How long is the longer term? Like
the longer term would be about another 10 years.
10 years?
Yeah. What we think is that investment demand would remain fairly healthy for both gold and silver over the next several years, largely because a lot of the problems that we've seen occurring right now are going to take a lot of time to get resolved, especially in the developed countries. So you're probably going to see strong investment demand, which should provide support. But then you also have all these other factors like low cash costs and fabrication demand getting hit, which would sort of weigh on prices.
In terms of this investment demand, which for both commodities, it's the major factor right now, do you see some point where that demand is satisfied, satiated? I mean, like they're holding whatever, 5% in their portfolios of gold and silver. That's where they want to keep it. And then we start to see a tapering off, or is this just going to continue?
We've seen that happen, especially when we see prices shoot up the way they did. You do sometimes see investors who bought gold or silver at maybe in 2009 or even 2010. They've made more than healthy profits in the last couple of years, and so you might see some liquidation from these investors, but at the same time you have other investors getting into the market and using those lower prices as buying opportunity. So
and I guess we ought to talk a little bit about platinum.
Sure.
Platinum.
For platinum, again, we expect prices to remain at elevated levels. In the case of platinum, the dynamics are a little different in that you have supply side issues, especially from South Africa, which are supportive of prices. It's mostly dependent on industrial demand because of its use in auto catalysts and other industrial uses.
So again, a little bit more economically sensitive.
That's right.
You'd say.
That's right. And it does get influenced to some extent by gold and silver as a safe haven, but not as much.
Not as much. But in general, for all three, still somewhat of a bullish outlook.
Yes, at least in the short to medium term, yes.
All right, great. Thank you very much, Rahit. That's it for now, folks. This is Mike Norman. We'll see you next time. Take care. Bye-bye.